So I want us to discuss on financial statement analysis, FSA. We'll be discussing on the notes I had shared with you, the one I had requested you to print. Financial statement analysis. Now, what's financial statement analysis? Now, financial statement analysis is the process of analyzing the company financial statement for decision-making purposes. That's what we call the FSA, financial statement analysis. It's all about the process to break down the complex financial statement into information that can be understood even by an accountant. That's what we call financial statement analysis. External stakeholders use it to understand the overall health of an organization as well as to evaluate financial performance and the business value. And we have tools of analyzing financial statement, which are those tools. So for the tools, they are classified into three. Number one, we have the common size analysis. Common size analysis. Then number two, we have the comparative analysis, as well as you can use the ratio analysis. The ratio analysis. So those are the key tools of financial statement analysis. Now kindly pay attention here. Let me explain. So starting with the first one, the common size analysis. Now for the common size analysis, this involves the identification of the base value which will be used as a determinant to determine how the various income statement and the statement of financial position they change. It's all about determination of the base value. Now, for the common size analysis, they are classified into two. A, we have a vertical common size analysis. And number B, we have a horizontal common size analysis. Now, for the horizontal common size analysis, it's also known as the trend analysis. So starting with the vertical common size, also for the vertical common size, it's classified into two. We have the profit or loss, as well as the statement of financial position. Statement of financial position. So they are classified in two. So we have the vertical common size analysis, and then we have the horizontal common size analysis. For the vertical common size analysis, under the profit or loss account, remember I said that for the common size analysis, it's all about identifying the base value. So for the vertical common size, to the profit or loss account, that is the income statement, the base value will be the sales revenue, the sales or the revenue. Whereby to the income statement, whereby you hold the revenue 100%, and therefore you express all the other item of the income statement as percentage of the base value, which will be the sales. Whereby you'll be holding the sales revenue to be 100%, then you express all the other item of the income statement as percentage of sales. Then to the statement of financial position, the total asset or total equity and liabilities will be our base value, whereby you hold the total asset as 100%. So to the income statement, the sales revenue will be our base value, we hold it 100%. And then for the total asset under the statement of financial position would be 100%. Therefore, to the statement of financial position, you express all the other item, assets and liability, each specific item as percentage of the total asset, which will be the base value. Then for the horizontal common size, mostly this is applicable when you're factoring the trend analysis, how the item changes from one period to another period. So therefore, horizontal analysis is only applicable where we have more than one financial year. And in this case, it involves the identification of a base year. Identification of a base year, whereby the base year, you hold all the item be it the income statement, be it the statement of financial position, as 100%. So for example, you have 2025, 2026. So in this case, where you are coming from, you don't come from 2026 to 2025, but you move from 2025 to 2026. So what will happen? All the item of the 2025, be it the income statement item, statement of financial position item, you hold them as 100%. And then you express the one for 2026 as percentage of 2025. Also, we may have another financial year, 2027. So you can also factor in the trend analysis for more than 2 periods. Now, for 2027, you hold for 2026 as the base value. So in this case, you hold it as 100%, then you express that for the one for 2027 as the base value of 2026. So now that's the difference between the vertical common size and the horizontal common size analysis. Good. So now let's use our notes. Go back to the notes. Go back to the notes. So you're looking at the tools of analyzing financial statement. And number one, we have said that we have the common size analysis. Number two, we have comparative analysis. And then number three, we have the ratio analysis. We start with the first one, the common size analysis. Now, for the common size analysis, it's categorized into two. One, there is the vertical analysis. Number two, there is the horizontal analysis. So we start with the vertical common size analysis. For the vertical common size analysis, each account or item in the financial statement is expressed as a percentage of the base account. Is expressed as a percentage of the base account. The base account for the income statement is the sales revenue. So for the income statement, the base value will be the sales revenue. And therefore, every item in the income statement is expressed as a percentage of sales, holding the sales revenue as 100%. This type of analysis allows the analyst to determine how various components of the income statement affect the company's profitability or the profit. Then at that point, the base account for the statement of financial position, that's the balance sheet, is the total assets or the total equity and liability. In this case, every item in the balance sheet is expressed as a percentage of the total asset, holding the total asset as 100%. Good. So now let's do that illustration. Illustration 1. Yeah, to that. Consider the following financial statement for Avibes Limited and prepare vertical common income statement, vertical common size income statement. So we have Avibes Limited, then we have the income statement. Whereby we have our revenue, then there is the cost of sales, and that's how we get the gross profit. Then there is the administrative expenses. We have the distribution expenses. And then we get the earning before interest and tax. Now, EBIT is also known as the operating profit. So the operating profit is the earning before interest and tax. And then you add the investment income so that you get now the earnings before tax. And then you raise the tax to get the net income. And the net income is our profit after tax. So our shillings are in thousand. So here we have it's 30,000. We have 12,000. And therefore the gross profit is 18. So we have 15. And we have 12. And therefore the earning before interest and tax is 15,300. Then investment income was 500 to get an amount of 15,800. Then you raise the tax, an amount of 3 to get 12,800. Good. So whenever you're given one financial year, The only thing that is possible here is only the vertical. For 1 year, you cannot perform horizontal. Horizontal must be more than 1 financial year. So now, how do you perform vertical common size? Now you see that for the common size, for the vertical common size, for the profit or loss account or the income statement, the base value will be the revenue. So that means in this case, we hold the revenue to be 100%. Then you express all the other items of the income statement as a percentage of sales. For example, 30,000 is equivalent to 100%. What about 12,000? It will be how much? So you just cross multiply. That 30,000 is equivalent to 100%. What about 12,000? It will be how much? So how will be getting that? Now to get that, you'll be taking now 12,000, you divide by 30,000, then times 100%. Here you'll be taking 18,000, 1,500, 1,200. You're expressing them as a percentage of sale. Then should be expressed in percentage. The second one is? This one is? 40%. So if the cost of sale is 40%, automatically the gross profit will be 60%. Sorry? We have 5%. We have 4%. Okay. 51%. 1.7%. 1.7%. So this one you get is 52.67%. This is 10%, and this is 42.67%. Good. So that's how you perform the income statement vertical analysis. Good. So therefore, you can be able, for example, in this case, how do you analyze this financial information? Now, the revenue was 10%. So the net income is 42.67%. What does it mean? So it means that for every 100 shillings of the sales, the net profit will be 22.67 shillings. For every 100 shillings of the sales, 42.67 is your net profit. So it means that, for example, how do you interpret the admin expense? Admin expense is 5% of the sales. So it means that for every 100 shillings you are generating from the sales, 5% goes to the admin expense. Distribution goes 4 shillings of 100 shillings goes to distribution, like that. That's the interpretation. That for every 100 shillings to the cost of sales was 40 shillings. And therefore, the gross profit for every 100 shillings, the gross profit is 60 shillings. Good. So that's how you interpret that. Good. Now let's do another illustration, illustration 2. But now we do for the statement of financial position. For the statement of financial position. Illustration 2. Consider the following financial statement for Everbs Limited and prepare a vertical common size balance sheet. That's the statement of financial position. Everbs Limited. Statement of financial position. So we have the non-current assets, whereby we have PPE. We have the intangible assets. Then we have investment property. That's how we get the total non-current assets. Then we have the current assets. So for the current assets, we have inventories. We have trade receivables. Then we have cash at bank. Then we get the total current assets. Therefore, you can be able to get the total assets. Then we have equity and liabilities. So for the equity and liabilities, we have the ordinary share capital. We have the share premium. And then we have the retained earnings. Then we have the non-current liabilities. For the non-current liabilities, we have a 10% debentures. Then you have the current liability. Have trade payables, and then we have the bank overdraft. Then we have the totals. So this is an amount of 22,000. Is 12,000. Then we have 5,000. And the total non-current asset we have is 39. And then we have inventories. We have 95. We have 11,500. We have 500. We have 21,500. And the total asset is 6,500. Under the equity and liabilities, ordinary share capital we have is 20. We have 6,000. Then for the retained earning, it's 11,900. Debentures we have is 12,000. We have 64. We have 42. And the total is 6,500. So how do we perform the vertical common size statement of financial position? Now we have said that for the statement of financial position, the base value will be the total asset or the total equity and liability. This one is a balance sheet whereby the total asset should be equal to the total assets and liability. So for the total asset, it becomes the base value. So you hold them 100%. So this one is 100%. Therefore, you express all the other items, the assets, liability, and equity as a percentage of the total asset. So, for example, you argue 6,500 is equivalent to 100%. What about 22,000? So therefore, you'll be taking 22,000, you divide by the total assets. So take 22. This is 20. Then you express them as percentage of the total assets, which is 6,500. and then you multiply by 100%. Should be expressed in percentage. So give me that. The person is 6. Let's work with 36.67. We have 19.83%. 8.26%. 64.46%. 15.75%. We have 19%. 0.83%. That 5.54. Now equity and liabilities. Sorry, that 3.05%. 9.9%. 19.67%. 19.83%. 10.58%. 60.60. 60. And you compute, don't read. Yeah. This is 4,200, not 42,000 over 6,500. So I just need the bank overdraft. 6.94%. Good. Yeah, so now that's the horizontal statement of financial position, whereby holding the total asset as the base value, which is 100%. What does it mean? So it means that the property, plant, and equipment represent that 6.67 of our total investment. Note that the total asset is the same as the total investment. So of all the total investment, that 6.67, it's made up of PPE. Intangible asset represent 19.83% of our total investment. Investment property, these are items held for capital acquisition and to earn rental income. They represent 8.26% of our total investment. And therefore, 64.46 represent a long-term investment. These are the total non-current assets. So it means that of all our total investment, 64.46, they are long-term. So that means the balance are short-term. That is, stock or inventory represent 15.75% of our total investment. A receivable represent 19%, which is too high. The short-term assets, the receivable should not be above 10%, but this one is 19%. So that means that we have more money outstanding that we have already earned, but we have not received. And then cash, 0.83. So that means if you are to assess the liquidity of this company, in terms of the liquidity, they are not performing better. Why? Because you see receivable is 19%. Therefore, there is no cash because most of our customers, they are not paying, which represent almost 20%. And then our current asset, the short-term assets, represent that 5.54 of the total investment. Now, when it comes to the equity and liability, this one represents how the total investment were financed. That's what's known as the balance sheet, how our total investment were financed. So the ordinary share capital represents 33.05. So it means that of all the total investment, 33 was financed by the owners of the company. That's the ordinary share capital, together with the share premium and the retained earnings. And these are the shareholders' wealth. Then, debenture, the long-term debt, represent 19.83. So it means that of all our total investment, they have been financed using 19.83% of the loans or debentures. And then trade payables represent 10.58, and then the bank overdraft is 6.94. Good. So that's what we call now a vertical common size. So whereby to the income statement, the base value is the revenue, and then to the statement of financial position, the total asset is our total, or is our base value. Good. And the solution are provided. The solution is already provided. Good. And now let's go to page 3. We look at the horizontal common size. Horizontal common size. Horizontal common size. So for the horizontal common size analysis, under horizontal analysis, each account value is expressed as a percentage of designated base year account value. Can you understand that? Designated base year. So here it's all about the base year, not the base value. So base year. So it's base year. This allows the analyst to see how the item have changed over a given duration of time. Horizontal analysis is also known as the trend analysis. Good. And we do that illustration. There is an illustration there. Consider the following financial statement for Evervibes Limited and prepare a horizontal common income statement for the year 2019 and 2020. Yeah, when you have more than one financial year, now that's when you perform a horizontal analysis. So let's do that illustration. So here we have 2019, and then you are given for 2020. Here we have it back to 4. Here we have is 12,500. Therefore, this is 21,500. 1,200. And then we have 1,800 for us to get 18,500. 200 to get 18,700. Then we raise 4 to get an amount of 14,700. Good. So now how do we perform the trend analysis? Now for the trend analysis or the horizontal, you identify a base period from 2019 to 2020, not 2020 to 2019. So whereby for the trend analysis, you identify a base year, not a base value. So of which in this case, our base year will be 2019. So this will be the base year. So it can be noted by PO. Therefore, this one will be P1. So it means that the base year will be 2019. You hold all the items, be it an asset, be it a liability, be it the income statement, all the item will be 100%. So here it's all about the base year. It's not about the base item. Then we express now the one for 2020 as percentage of those of 2019. For example, you argue 30,000 of the revenue is equivalent to 100%. What about 34? So 30,000 is equivalent to 100%. What about 34,000? It will be equivalent to how much? So in that case, you'll be taking 34, you multiply by 100%, you divide by that. So therefore, to get that, you'll be taking 34,000, you divide by 30, and then you multiply by 100%. This will be 12,500 into 1,500, we have 12, 18, 18,500, 200, 18,700, 4,000, and 14,700. Then you express them as percentage of the base year. So the base year. The cost of sales for year 2019 was 12,000. This was 18,000, 1,500, 1,200, 15,300. We have 15, 15,800. We have 3,000. We have 12,800. And then you express them as a percentage. So 34 over 30, then you multiply by 100, you're getting 119 point? Yeah. To get 113.33%. 104.17%, 119.44, 80%, 150, 150%, 120.92. This is 40%. 118.35%. 133.33%. And what we have? 84%. Good. So that's how we perform a horizontal analysis. So it means that in this case, we are concerned about the percentage, whereby we can say that the revenue for 2020 was 113.33% of that of 2019. The net profit for 2020 was 114% of 114.84% of that of 2019. Whereby, if you are to determine now the percentage change, now that's what gives rise now to our second tool. Remember, I said that there are three tools of financial statement analysis. One was the common size, the other one was comparative. Now, for the comparative, you are comparing one period against another period. It's more of the trend analysis or horizontal. But now for the comparative, the difference between now this and the comparative is that, for example, in this case, we are expressing that this is 113.33% of that of 2019. Now, when it comes now to comparative, now what we need here, it's all about the percentage change. This one will be concerned with the percentage change. For example, this was 100%. This is 113. So that means there was an increase by 13.33%. This was 100%. This is 104. So there was an increase of 4.17%. This was an increase by 19.44%. Now, for the admin expense, this was 100%. This is 80%. So it's a reduction by 20. So this one, a reduction by 20%. When you focus only on the percentage change, now that one becomes comparative. But now for the trend or for the horizontal common size, you have to show the entire percentage. And how do we get the percentage change? By taking P1 minus PO over PO times 100. So the key concern here is the comparative or the absolute change. For example, this is what I mean. If now you have to perform the comparative on this, you take P1, which is 34,000, that is for the sale, minus PO, the base here for the revenue was 30,000, you get the change. So you see, if you take P1 minus PO, the concern is to determine how much was the change. Then you divide by the PO. So the PO for the revenue was 30. Then you multiply by 100%. Can you take 4 over 30? So you get, it's an increase of 13.33%. For example, if you have to take the net income, so you take P1, it will be 14,700 minus PO, which was 12,800, so that you get the change. Then you divide by PO, the base value, which was 12,800 times 100%. So what do you get? Yeah, you get 14.84. Let's take one with a reduction. For example, if you have to determine the one for admin expenses, admin, you take P1 is 1,200 minus PO, its PO was 1,500, so that you get the change, which is the reduction. You divide by the PO, which is 15 times 100. So what do you get? Which is negative, right? Yeah, it will be negative 50 no, 20. 20%. That from 100 to 80, a reduction by 20. So now that's the comparative analysis. So let's go back to the notes. Go back to the notes. We are in page 4. Comparative statement analysis. Comparative is all about comparing. Now, comparative statement deals with the comparison of different items in the profit or loss account and the balance sheet of two or more periods. Can you arrange that? Two or more. So that means in this case, for the comparative, it's more of the trend analysis. You are comparing between two or more periods. Good. I think I've explained that. There is an illustration there, page 5. Let's go to page 5. Page 5, there is an illustration there. Consider the following financial statement for Evereps Limited and prepare comparative income statement for the year 2019 and 2020, of which you are given the same details as this. Actually, the same financial statement, but in this case, they need comparative. So you're given the income statement for 2019 and 2020. Now let's go to the solution. So for the solution, so first you need to compute the absolute change. And how do we determine that? By taking P1 minus PO, where P1 is a subsequent period or subsequent year, PO is the base year. And if you look at those solutions, for example, for the revenue is 13.33, and that's what I was explaining. If you look at the net profit, it is 14.84. Yeah, so that's what I was trying to explain. Good. Now let's look at the advantages of the common size or comparative advantages. Now, for you to understand the advantages, we'll come to discuss that. But the key element is the disadvantages. Now listen up here. For the financial statement analysis, we see that there are three tools of financial statement analysis. One is the common size. We have the comparative. Number 3 is the ratio analysis. All of them, they have the same advantages and the same disadvantages. So one of the major advantages of this method, they help to break down complex information into information that can be understood even by an accountant. Another thing is that they use accounting information, of which information is readily available. So that means the cost of providing information is very low. It's not expensive. But for the disadvantages, I don't want you to cram. I want you to understand disadvantages. Disadvantages, you go with the disadvantages of ratio analysis. For those who are doing financial management, I focus more on the disadvantages of ratio analysis. Kindly don't forget about this. What are some of the advantages of using this? One of the disadvantages is that it is using accounting information, of which this accounting information is subject to manipulation. So for example, if I want to attract more investors, there is a way the company can manipulate their revenue and their profit so that they can show a more increase. For example, instead of 14%, even you can get 130%. Why? Because the financial statements are prepared by the management. Accountant is part of the management. So that means the management, sometimes they can be able to achieve their target from the outsiders by manipulation of the financial statement. So that's one of the disadvantages of ratio analysis or this analysis. Why? Because we are using accounting data which is subject to manipulation. Number 2 of the disadvantage, it does not take into account the concept of time value of money. It does not take into account the concept of time value of money. Another thing, it does not take into account the effect of inflation. For example, if you look at this data, this is 34. So the perception is that revenue has increased, but sometimes revenue can increase not as a result of improvement in the business. No, it can also increase as a result of inflation, general increase in prices. For example, currently the price of fuel is going up, but that one does not mean that the petrol station, they are earning well. They are not. There is nothing that is changing. Even to them, the business is not performing better. They are not selling more than what they used to sell. But per liter, what they used to sell, for example, 180, even the price can go up, of which it will go up to over 200. So it means that in this case, the revenue will be high because the selling price has increased. So that means our revenue can increase as a result of increment in selling price, which is triggered by the inflation. But that one does not mean that the business is doing great. So therefore, in this case, there is no adjustment of the effect of the inflation. So it's another disadvantage. Let's say that number 1, it uses accounting information which is subject to manipulation. Number 2, it does not factor in the concept of time value of money. It does not take into account the effect of inflation. Number 4, In case of different accounting policy, we cannot do what we call an industrial comparison. You cannot compare the performance of your company against another company. Why? Because there is different accounting policy. When there is different accounting policy, it's difficult to do what we call an industrial analysis. You cannot compare your company performance against another company's performance. For example, if you look at this, admin expense and distribution expense. For this company, this one has reduced by 20, this one has increased by 50. So if you are to look based, if you are to use this against another company in the same industry, and then you are trying to argue, at least we are able to cut on our admin expense. What about the other company? How much is their admin expense? But if the two companies have different accounting policy, for example, we say that expenses are classified into 4 when preparing the published financial statement. There is a cost of sale, admin, distribution, or finance cost. Maybe your company policy is to classify depreciation to the cost of sales, but the other company, the same asset, their depreciation is classified to admin expense. Are you getting what you mean by the difference in accounting policy? Your accounting policy is to classify these expenses under this, but the other company, the accounting policy is to classify under different items. So in that case, you cannot be able to compare these specific components. So it becomes difficult. Another disadvantage of financial statement analysis, it only captures the quantitative. It only captures the quantitative element, therefore ignoring the qualitative. What does it mean? In this case, our focus is numbers, but there are some other things that you need to factor other than the numbers. For example, let's look at admin expense or distribution expense. Distribution expenses increased by 150. I want to show how the quantitative and the qualitative, sometime when they ignored, what could be the effect. So distribution expenses increased by 50 million, increased by 50%. But for the other company, maybe their distribution expenses reduced. Why? Here we have two companies. We have company A, we have company B. Company A, the distribution or admin expense, let's work with admin expense, increased by 50%, but here reduced by 20%. So these are a cost, it's an admin expense. You see, for you as an investor, when you're looking or you focus on the financial statement, here you assume that company B, they are doing better. Why? Because they are trying to reduce, to minimize on cost. And when they minimize, so we are arguing that if company admin expenses increase by 50, but for B reduced by 20, so in business, if you minimize on cost, you expect your profit to increase. When your expenses increases, you expect your profit to reduce. So that means in terms of financial statement analysis, as a stakeholder, you prefer company B. Why? Because they are trying to save on cost. And when they save on cost, you expect them to increase on profit. But on the other hand, if you look at other element, without looking at the financial element, maybe B, they minimize their cost by firing some staffs. They merge some department, they fire some staffs. So what will happen? Automatically, if you fire some staffs, you then don't need much space, the office they are using. So that means in that case, the cost will reduce automatically. Then B, company A, what they did, they care about their staff welfare. They adjusted all the employee salary by 10%. They increased their salary by 10%. Then they provided better facilities. So in that case, A, expenses increased. B, they fired people, the cost reduced. You see, that one will not be captured in the financial statement. Now, when you're given the other side of the story, which one will you prefer now? A. Are you getting? Because if you focus with financial statement analysis, they'll only focus on the numbers. Numbers, you make your decision based on the number, but therefore ignoring the qualitative. But you are told that here cost increased because our employees, we gave them more an additional salary. We improved their welfare. Tukanunulia viti mpya. So now they have a better working condition. Lakini hapa ni kufuta, tunafuta watu kuwakati mishahara. So now when you're given the other perspective, you'll come to see that company A is doing better than B. So those are some of the advantages and the disadvantages of ratio analysis or the financial statement analysis. Let's go back to the notes. Now we look at financial ratios. Financial ratios. The other tool was financial ratios. And ratios are classified into 5. Let's go to that. Ratios can be categorized into 5 categories as follows. One is the investors or valuation ratios. Investor or valuation ratios, they are those ratios used to determine the value of a company. They used to determine the value of a share, the value of preferred share, the dividend per share, the earnings per share. Number 2, we have liquidity ratios. Now, liquidity ratios, they are those ratios which indicate the ability of the company to settle short-term obligation when they fall due. Then number 3, we have gearing or leverage or solvency ratio. These are ratios which indicates how the extent to which the company has borrowed. Gearing or leverage is the use of the debt. So they show the extent into which the company has borrowed. Then we have the profitability ratio. Now, profitability ratio, they are those ratios which indicate the ability of the company to generate returns in form of revenue, in form of investment. And then number 5, activity or efficiency or turnover ratios. These are ratios used to determine how well the company utilizes their resources in order to generate returns. And those notes, it was a copy paste of the financial management. So I want to give you 7 minutes. Kindly go through the financial ratios. Just go through them. Look at those ratios, then we can do some illustration. Just go through them, then we come and do some illustration. So now let's start, try some question on ratio analysis. Can do one question or two. Open with me, December 2025. Question 5C. The newly employed accountant of Bakers Limited, you have been presented with the following financial statement. So we have the statement of profit or loss for the year ended 30th of June 2024 and 2025. So you have for the two financial year. Then you also have the statement of retained earnings for the year ended 30th of June 2024 and 2025. And then we have the statement of financial position for the 2 years required. Compute for the 2 years the following ratios for the 2 years. One is the return on capital employed. Yeah, return on capital employed. Now, for the return on capital employed, here you take the operating profit, and the operating profit is the EBIT. You divide by the capital employed. And the capital employed is the same as the net asset. That is, you take the total assets minus the current liabilities. And in this case, we need for the 2 years, we have 2024, we have for 2025. So how do you determine that? So take the operating profit, you get the operating profit from the income statement. So from the statement of profit or loss, the operating profit here is an amount of 52. Here it's an amount of 100,000. Then you divide by the capital employed. So how do you get the capital employed? So to get the capital employed, you take the total assets minus the current liability. That's how you get the capital employed. So for example, for 2024, the total assets is 369,000 minus the current liabilities. So for the current liability, we have accounts payable, which is 37,500 minus accruals. The accruals is 25,500, 10 times 100%. Then for 2025, you take the total assets, which is 308,000. That is the total asset minus the current liability. We have payables for 26,500 minus accruals, which is an amount of 20. And then you multiply by 100%. So give me that. This one is 16.99%. At 3.24%. And then number 2 is the asset turnover. So how do we get the asset turnover? So to get the asset turnover, it's very simple. Turnover is the sales. So you take the sales over the total assets. So that's how we get the assets turnover. So by taking the sales, so how do you get the sales? You get the sales from the income statement, and we have the net turnover is an amount of 456,500. Here we have is an amount of 420. Then you divide by the total assets. So total asset is 369,000. Here was an amount of 308. So give me that. Sorry? 1.24 times, or 1.24 is to 1. 1.36 times, or 1.36 is to 1. And then number three of the question. And the current ratio, now that's a liquidity ratio. Current ratio is one of the easiest ratios by taking the current assets over the current liability. Current assets over the current liability. And we see that the recommended ratio for current ratio is 2 times, or 2 is to 1. So you take the current assets. So to get the current assets, we have inventory. This is 147,000. We add account receivable, which is 80,000. We add cash and bank balance, an amount of 26. Then you divide by the current liabilities. Current liability, we have account payable, 37,500. And then we have accruals, 25,500. So I do the same here. Inventories is 118,500. We add 24,000. You add cash and bank balance of 28,500. Divided by the current liabilities, we have 26,500, and we have 20,000. So give me that. 2.02 times, or 4.02. So this is 4.02 times, or 4.02 is to 1, about 2025. $3.68 times, or 3.68 is to 1. And you see that the recommended ratio for the current ratio is at least 2 times. But in this case, it means that our current assets are 4 times that of current liability. So in terms of the liquidity, this company is performing better. And then number 4 is the quick ratio. Yeah, this ratio shows the ability of the company to settle short-term obligation from the most liquid current assets. And how do we get this? By taking the current assets minus the inventories over the current liability. So therefore, in this case, you'll be taking, you don't factor in the inventory, so you'll be taking only the account receivable, which is 80, plus cash, which is 26, over the current liability, 37,500 plus 25,500. Here the same. You don't factor in inventory, so it will be 24 plus 28,500 over the current liability, 26,500. This is 20. 1.68 times, or 1.68 is to 1. For the quick ratio, the recommended ratio is 1 is to 1, but it's above 1. It means that in terms of liquidity, we are better. 0.13 times, or 1.13 is to 1. And then lastly, number 5 is the debt to equity ratio. So debt to equity ratio. So to get the debt to equity ratio, this is part of the gearing ratio. And how do we get the debt to equity ratio? By taking the long-term debts. Yeah, this is the non-current liability. Then you divide by the equity. And you say that equity is made up of the ordinary share capital, share premium, retained earnings, not preference share capital. Preference share capital is not part of it. So take the non-current liability. So what do we have? So for the non-current liability, we have debentures. We have 58,500. Also, we have the preference share. Preference share is part of the long-term debt. And then you divide by the equity. Equity is made up of ordinary share capital, the share premium, and the retained earnings and other reserve. So here we take the ordinary share capital, which is 50,000. There is the retained earnings, an amount of 157,500. What do you get? And this one can even be expressed in percentage. And then for the other year, you take the debentures, an amount of 37,000. You add the preference share capital, which is 25, and then over the equity. Equity, the ordinary share capital is 50,000, and then you add the retained earnings, 149,500 times 100. What do you get? 47.47%. One. 21.08. 91. That 1.08%. Good. So you can take a screenshot of that. That one is not in your notes. April 2025. April 2025. Question 2B. April 2025. Question 2B. Now, question 2B after that. Let's start with question 2A. Distinguish between government grants and government assistance as per IAS 20, government grants. So it's in your handout, accounting for assets and liability. And I've differentiated between a government grant as well as government assistance. You get your 4 marks. What about part B? Venture Capital presented the foreign financial statement of Brook Limited for analysis. So we're given the income statement for the year ended 31st of December 2024. And then we have the statement of financial position for the 2 years, 2023 and 2024. Required. 1. Vertical analysis of the statement of profit or loss. So the income statement, you're only given one. You're only given one. So therefore, even if you are not told, if you're given one, you cannot perform horizontal. That one must automatically be vertical. So in this case, they needed the vertical analysis of the statement of profit or loss. So in that case, you hold the revenue to be 100%. Then you express all the other items as a percentage of sales. Then number 2, horizontal analysis of the statement of financial position. The statement of financial position you are given for 2 years, whereby you have to, for 2023 and 2024. So for the horizontal, this one will be our base year, PO. So you hold all the items as 100%, and then you express the one for 2024 as percentage of 2023, and you get an additional 16 marks. So 16 plus 4 for the theory, and those are 20 marks. Now look at another one. December 2024. December 2024, question 5C. December 2024, question 5C. Let's start with the question 5A. In relation to IAS 41, agriculture, explain the following. One, recognition of biological assets. So how do we recognize the biological asset? I think we discussed that. Number two, how do we measure the biological assets? I remember explaining that initially the biological assets are measured at the fair value, less any estimated cost of sale at the point of harvest, etc., etc., etc. I'm not reminding you. Part B. So get your 4 marks. Part B. Explain two types of post-employment benefits plan in accordance with IAS 19. Yeah, employee benefit. And you see that there are two types of plans. We see that there is a defined contribution plan and there is defined benefits plan. And they explain both that for defined contribution plan, the amount of pension payable upon retirement will depend on the amount of the contribution that was made into the plan by both the employee and the employer. For defined benefit plan, the amount of pension payable upon retirement will depend either on the final salary of the employee or the average annual salary of the employee during the career service. And how do you determine that? That will be depend with the actuarial assumptions. And you get an additional 4 marks. Those are 8 marks. Then part C, Baraka Limited is a private limited company that operates in the hospitality industry. The following statement of financial position have been extracted from the accounting records of the company for analysis purposes. So given the statement of financial position as at 31st of August, we have 2024 and we have 2023. Sometimes be very keen on how you're given this financial year, 2024 and 2023. If you're given more than one period, not unless they are specific. So for example, in case they are silent, if they tell you perform a common size analysis, if they are silent, and we have more than one period, you perform a horizontal. This one will be PO, this one will be P1. This is 2023, 2024. But in this case, they are very specific, required. Prepare a common size vertical statement of financial position for 31st of August, 2023 and 2024. So this one, they don't need horizontal. They are very specific. They just need vertical. So for vertical, you perform each year, whereby the total asset will be 100%, 100%. And then you express all the other items as percentage of the total asset. You get an additional 12 marks, and that's a total of 20 marks from that question. Mm-hmm. Mm-hmm. Open December 2022. December 2022. December 2022. Question 4B. Question 4B. Hmm? 4B, let's start with 4A. Now, you see, now we are done with the syllabus. So that means you can be able to answer all the questions. You have all the information necessary. And start with even question 4A. Ratio analysis has over time proven to be a useful financial tool for decision making. That's very correct. However, reliance on ratio for decision making has inherent limitation. Required. Citing 6 limitation, justify the above statement. Limitation of ratio analysis, we have just discussed them. That number 1, it uses accounting information which is subject to manipulation. It does not take into account the effect of inflation. It does not take into account the concept of time value of money. It only captures the quantitative analysis, therefore ignoring the qualitative analysis. Yeah, in case the companies have different accounting policy, it hinders the comparison, etc., etc., etc. Get your 6 marks. Number B. The following draft statement were extracted from the books of Mulima Limited as at 31st of December. So you have 2021 and 2020, both the income statement and the statement of financial position are required. Calculate for each year 2 ratios for each of the following user group, which are of particular significance to them. Number 1, shareholders. For each of the year, you calculate 2 ratios which are of significance to the shareholders. Now, shareholders, so this is where now the classification of ratio comes in. Shareholders mostly will focus on the valuation or the investors ratio, which include what? Earnings per share, dividend. Actually, these are enough. How do we get the earnings per share? By taking the total earnings, you divide by the number of shares. How do we get the dividend per share? By taking the total dividend, you divide by the number of shares. Even you can get the dividend payout ratio. Dividend payout ratio by taking the dividend per share over the earnings per share. So that's more than what we need. We need only 2. You ask yourself, do you have the total earnings? Yes. You go to the income statement. From the income statement, you take only the profit for the period, the profit after tax. This is what we take. The total earning, this is the profit after tax, not the retained earnings, the profit after tax of which you are given. If you look at 2021, the profit for the period was 23,320. For 2020 was 19,040. Then, to get the dividend per share, below it, we pay the dividend from the profits. From the profit for the period, you are given the dividend paid. So you'll be taking the dividend for each year, you divide by the number of shares. Now, the question is, how do you get the number of shares? You go to the equity. So under the equity, there is share of 20 each. See, both here they are the same. So you'll be taking 19,840. You divide by the par value of 20. This 19,840 is shillings, is monetary value. We need the number of shares. You divide by the par value. That's how you get the number of shares. So then you go to number 2. Number 2, now the other user is the trade payables. You ask yourself, what are some of the ratios that will be of significance now to our suppliers? Those are our creditors. Which ratio are those? Now, for the trade payables, for them, they are not concerned about whether you're making profit or loss. The issue is that if we supply goods to you, will you be able to pay me? So I remember these are payable. They are short-term liability. So therefore, their major concern will be on liquidity. Now, this is where you use one of the easiest ratios, the current ratio. Current ratio by taking the current asset over current liability. If you have that, the second ratio is the quick ratio. Quick ratio or the acid test ratio, whereby you take the current asset, then you exclude the inventory over the current liability, and you have your 2 ratios for the 2 years. Then you go to number 3. Number 3 is internal management. Now, for internal management, if I'm a student, I just copy paste this one here. For internal management, all the ratios are of significance used to the management. If I were a student, so that I don't waste more time calculating, I just factor in the earnings per share, what I got here. I can even take dividend per share. Also, I can take the quick ratio or the current ratio or even dividend payout ratio or any ratio that you know. any ratio. For example, you can take gross profit margin. Gross profit margin by taking the gross profit over sales. You can also take the net profit margin. How do you get the net profit margin? You already have the profit after tax. You take the profit after tax over the total sales times 100. So in this case, for the internal management, you can use any of the ratios. And then number C, if you're able to answer number B correctly, part C, you get 3 marks. Why? Because you're told that comment on the changes between the 2 years. Comment on the changes. That's one of the easiest. If they tell you to comment on the changes, for example, here you had for 2021 and 2020. If this was 4.2 and this is 4.1, what will you say? You see, this is 2020, this is 2021. So you are not moving this way, you are moving this way. So from 4.1 to 4.2, just write a narration. The earnings per share increased from 2020 to 2021. If it was a reduction, that's what you comment. The same here with the quick ratio. For 2020 was this, for this one was this. So it was an increase or reduction. And you end up getting 20 marks in that question. Let's proceed. August 2022. August 2022. Question 5. August 2022. Question 5. Yeah, 5B. We can even start with question 5A. Discuss the business concept of triple bottom line as applied in financial reporting. Triple bottom line, the TBL. I remember discussing that. So that it indicates 3 perspectives: planet or environment, social or people, and then the profit. Do you remember discussing that? Yes, good. You get your 8 marks. So how do you get the remaining 12 marks? Let's go to part B. Dragon Limited is a public entity which has grown in recent years by acquiring established business entities. The director, all that. Let's go to the income statement. From the income statement, we have the statement of profit or loss for the year ended 30th of April 2022. We have for Able Limited and Cedar. Now, these are 2 different companies. It's not one company. You see, trend analysis can only happen, the trend analysis of horizontal can only happen when you're given financial statement of one company for more than one period. For example, this one, 2020, 2021. But in this case, those are 2 different companies. Even without reading the requirement, automatically it will be a vertical analysis. It can never be horizontal. Horizontal, it's only effective when you only have one company for more than one period. So we have income statement and we have the statement of financial position. Required. 1. The common size statement of profit or loss. You see, the examiner is silent. Common size. It's upon you to figure out whether it's a horizontal or vertical. Whether it's horizontal or vertical. And I've already explained how to differentiate between the 2. So this will be a horizontal. Number 2, common size statement of financial position. And then you advise the director of Dragon Limited on the best company to take. So that one you can make that decision in terms of the asset base or the profit. You just comment. Get your 20 marks. We go to the next, actually the next page, April 2022. April 2022. Question number 2. April 2022. Question 2. So another 20 marks waiting for you. Supercar Limited deals in car accessories. Roughly 75% of the sales are on credit, while the balance are on cash sales. Supercar Limited engaged an analyst who extracted the following summary of the industry ratio? Those are, can you write the word industry ratio? Industry ratio. Those are the ratios of the industry. So there was return on year capital employed. That's what we call return on capital employed. There is net asset equal to capital employed turnover, gross profit margin, net profit, blah, blah, all that. Then you're given the financial statement. We have the income statement, and then we have the statement of financial position. Added information. Supercar Limited received 600,000 from a sale of plant that had a carrying amount of 400,000 at the date of sales. 2. The market price of Supercar Limited share throughout the year averaged to 375. That's the MPS, the market price per share. 3. There was no issue or redemption of shares or loan during the year. 4. Dividend paid during the year ended that 1st of December 2021 amounted to 450,000. These were the dividend paid. Maintaining the same dividend paid in the year to 31st of December 2020 required. With reference to the industry ratio, analyze the compute the equivalent ratio for Supercar Limited for the year ended 31st of December 2021, 12 marks. Now the problem is not calculation, the problem is interpretation. Understand what they have asked, of which most of the students they fail because they never understand what are industry ratio. But you're already given. There is something I have told you to underline. Can you see that? What did I tell you to underline? Industry ratio. For example, the first one was what? Hiyo ni kazi ya macho. Return on capital employed, right? Yeah, so the return on capital employed was the first, was one of the ratio of the industry ratio, which is 28.1%. Now the question is, can you go back to the required? With reference to the industry ratio, compute an equivalent ratio now for this company. So this is for the industry. You compute for the company. Now, this is where now you get the formula. How do we get those? Return on capital employed. You take the operating profit. You divide by the capital employed. And the capital employed is our net asset. And then you multiply by 100%. For example, in this case, you take the operating profit. You get it from the income statement. And from my income statement, can you see the operating profit? How much is the operating profit? The operating profit is 900. Operating profit is the earning before interest and tax. Then you divide by the capital employed, of which from this company, there is revenue, cost of sales, they deducted the gross profit. Then you raise the operating expense. If you you deduct the operating expense, you get the operating profit, which is an amount of 900. You divide by the capital employed. How do you get the capital employed? By taking the total assets minus current liability. For example, in this case, you take 5,800, which is the total asset, minus the current liability. Current liability we are given is 24 times 100%. Give me that. It's 26.47. And that's now how it will be flowing. For example, the other one is what? Can you go to the second ratio? The industry ratio was what? Net asset turnover, of which we are told that net asset equal to the capital employed turnover. So to get the net asset turnover, whenever you see the word turnover, means sales. So here you'll be taking the sales of a net asset, of which you are told that in bracket equals to capital employed. Capital employed. So here you'll be taking the sales. How much was the sales for the company? 20,000. How much is the net asset of the capital employed? This is what we have just calculated here, capital employed, by taking the total asset minus the current. So what do you get? $5.88 times. How much was for the industry? for the industry was 4 times. Now that's how you calculate that. So how am I comparing this? This is 4, this is 5. Because part B of the question, can you go back to the part B of the question? Now, if you answer part A of the question, part B, you just require any 4 points of which you are told that using the ratio computed in A above, analyze the financial performance and the position of Supercar Limited for the year ended that 1st of December 2021 compared to the industry. For example, this one, here you just need to comment. Only 4 items are enough. Return on capital employed for the industry was 28.1. For our company is 26. So just say that the return on capital employed for the company is lower than that of the industry. That's enough. There is nothing more you need to explain. This one, the net asset turnover for the company is more than the industry. This is 5.88. This was 4. But you just need to comment 4 items. It's all about knowing those ratios. For example, the other ratio was what for the industry? Gross profit margin. You just need to know how do we get the gross profit margin. And to get the gross profit margin, here we take the gross profit over sales times 100%. All the profitability ratios are expressed in percentage. How much is our gross profit? The gross profit was 27.50. The sales for the company was an amount of 20,000. Then you express in percentage. 13.75%. Can you compare that with the industry? How much is it for the industry? The gross profit is 17. So if you are to comment this, the gross profit margin for Supercar Limited is below that of the industry. Of the industry, 17 hours, 13.75. And you end up getting your 20 marks. Good. And that marks the end of, you see, now I'm giving you this other task. Go and try to do this question. I think I've explained everything. I have done them, all of them, indirectly by explaining what they mean. Good. So that's enough for financial statement analysis. And kindly revisit the advantages and the disadvantages of those ratio analysis.